So good afternoon, everybody, and a very warm welcome to our virtual Fireside Chat, which we have imaginatively titled Identifying Great Founders Who Can Build Great Businesses. Thank you for taking the time to join us this afternoon. I'm Shiv Gupta, CEO of Sanctum Wealth, and your host for the session. Joining us today for the chat are Kunal Bahl and Rohit Bansal, co-founders of the Ace Vector Group, which includes Snapdeal, Unicommerce, and Stellaro, and Titan Capital, through which they have invested in more than 250 startups across various sectors. They both have illustrious track records and several recognitions to their names, which it might take me the length of this session to recount, so I won't. Suffice it to say that they're well-known names in Indian industry in general and startup investing in particular. And they have been supporting entrepreneurship in wide-ranging ways, from involvement in policy to government and industry advisory bodies, to action in the form of capital and mentorship to entrepreneurs. Kunal is a graduate of the Jerome Fisher Program in Management and Technology from the University of Pennsylvania and holds degrees in engineering and business from the Wharton School. Rohit completed his bachelor's and master's in computer engineering from IIT Delhi. Delighted to have you with us, Kunal and Rohit. Thank you very, very much for taking the time.
Thanks for having us, Shiv.
Pleasure. Our discussion...
The pleasure is all ours.
Excellent. Thanks, Rohit. Our discussion today will revolve around great founders, great businesses, the world of startup investing, and of course, Titan Capital, the Titan Capital Winners Fund. The session will last for 90 minutes, and we will focus on topics that investors typically ask us about. So that's a little bit of thrust of the conversation. However, do feel free to ask questions during the session using the chat feature. You can put it to hosts and panelists if you like. We will try and answer as many of the questions as we can. And if we don't have time to answer some of those questions, we'll record them and get back to you through our teams. So with that, we'll get started. We hope you find the session engaging and insightful. Let's start a little bit with some background questions. I know you might have been asked these questions 100 times before, but it's useful to set a little bit of context from here. And this is really how you got started with Titan Capital. So, how has your entrepreneurial journey led you to the point that you started Titan Capital, right? What inspired this, and was there a pivotal moment, or did it just sort of evolve into it? And then how has it played out?
Sure. So once again, Shiv, thanks for having both of us here. It's a real pleasure. It's always fun to take these opportunities to reflect back on our own journey, as well as share what we find exciting about this great startup ecosystem that we've been a part of now for a good part of 17 years. So actually, when we started in 2007, our business, there was nothing known as a startup. It was either it was a business or you did a job. And typically the business was a family business. So very few people of a young age were actually, you'd see, starting up in novel industries. And in the early days, it was quite a struggle for us to raise capital. There were maybe a grand total of 6 or 7 VCs in India. Most of them were US returned. And so they were also figuring out the Indian market. And they just started like 2006, 2007. And there was really no ecosystem of very early stage investors, what we call angel investors, or now there are various terms, seed investors, micro VCs, etc. That ecosystem practically was absent then. And the few angel investors that were there were, I can tell you, seem more like demons than angels. I vividly remember Rohit and I went and met one of the, someone in the real estate space whose son had just returned after doing engineering from Purdue in the US. And after a 2-hour meeting, they made an offer to invest in our company. They wanted to invest 50 lakhs for 60% of the company. So actually, that was a big realization for us that India needed, for the ecosystem to grow, at some point in time, we will need a more vibrant domestic capital ecosystem at the early stage. And we also felt that if we ever had the opportunity, the resources to do some of that ourselves, we must do it. So honestly, we started investing now 13 years ago, primarily because we wanted to help founders and help the next cohorts of founders in whatever small way we could. It was not just capital, because honestly, we didn't really have much capital when we first started, but it was more so mentorship, network, giving them access to our learnings, our mistakes, and things that we did well also. that's how we really got started. And then over the next 13 years, across the arc of building Titan Capital, we've just been very focused and disciplined on the early stage. We don't invest in later stages, partly because we really enjoy investing at the earlier stages, and also partly because we feel that we can be most helpful at that point in time towards these founders, because the um, pattern of making mistakes is very, very similar across the board. Like VC founders make the same mistakes that we made maybe 15, 16 years ago. So just helping define the guardrails, reviewing their progress frequently, helping troubleshoot, and helping them find solutions to the many pressing problems, particularly in the early stages of the business, and keeping them very, very focused on one problem at hand.
Honestly,
So
that's also the big reason why, while we wanted to invest, but founders, as we started investing in companies and founders kept on coming to us because in the founder's mind, we made an interesting fit where we were investing capital, yes, but over the years there have been many sources of capital available to smart founders. What was still missing was people who acted as a bridge between operators and investors. And I think that they saw it. I mean, while on their cap table we are investors, most of these founders treat us like peers, and they would discuss very, very sort of honestly and candidly what's going on in the business. They actually solicit and seek our advice because they know it comes from a place of wishing well for them, but also from a place of experience of having seen multiple and built multiple businesses in India. So that's, I think, which is what kept us going in some ways as well.
Well, thank you. Those answers are prompting so many questions from me that I have to exercise some discipline myself to stay focused. But I should ask this question just as what evokes, in you, what excites you in the way that do you see yourself as entrepreneurs, or do you see yourself as investors now that you've sort of made this transition? Is there a way to think about this, or it doesn't really matter? It's you do both.
yeah, we feel that it's a very traditional way of looking at the world, that you have to be only one. The world is 2024 is a very different world from the world in the past, and the world in the future will be very different from 2024. So we lead plural lives, where as operators and investors, and a lot of the learnings we have as operators are very beneficial when we are making investments, assessing companies, because we can get to a level of depth that obviously others can, but we know we can, because we've built businesses from absolute zero, like literally zero, when there was nothing, just an idea in our heads, to 100 million customers in one business, a billion orders being processed in another business, so on and so forth. So the being an operator is helpful, we feel, in being a better investor, and being an investor helps us being a better operator, because we stay up to date on what's going on in the world, latest practices in marketing or supply chain, or just general technology, AI, etc. And so it's a bit of a flywheel between investor operator that I feel is our special sauce also.
I think
Usually, sorry, go ahead, Rohit.
I was saying that, being an operator gives us a lot of depth because, as an entrepreneur, like many of the people on this group would also probably understand, there are many, many very wide variety of situations one needs to handle. Some are comfortable, some are uncomfortable, and just the level of depth required to run a business is extremely different from the level of depth required to be an investor. That said, being an investor sort of helps you have a much wider lens in some ways of being able to see similar patterns across a wide variety of businesses. And as a result, have that sort of zoomed out view of seeing what are the best practices, which companies are doing a good job, what are they excelling at, and as a result, can we pick this best practice from this company? Can we try to implement it in some other company, etc.? So that way, I think doing both in some ways helps us gain both depth as well as sort of breadth of perspective.
Sure. So I mean,
Also, I feel, Shiv, that the best founders, and we have a very, very high bar on founders. The best founders very quickly grow out of their early stage investors, because the early stage investors themselves are not growing often. And because when you're operating, variety of businesses, software, marketplaces, e-commerce marketplaces, brands, you have to keep churning your brain also all the time and keep learning new things. You're making new mistakes on a daily basis and having new wins on a daily basis. So, as the founder, the investee founder's journey progresses in building his or her business, the nature and complexity of their problems also change. And given that we have seen businesses literally from zero to IPO, we kind of are well tuned to either know exactly what needs to be done in a particular situation, or at least have the framework in our mind to figure out how to solve it, or at least know someone through our network who can help solve it. And that founders find very, very beneficial. And to just reiterating Rohit's point, which is why they're very honest with us in their, they don't really think of us as investors. They think of, which is why they would often come meet with us 4, 5, 6 times a year and constantly keep us proactively posted on on their progress, as well as asking us the questions around how do they solve some pressing problems in the business.
And also many times, if things are not going so well, we would usually the first people they would call, because they know these people are entrepreneurs, so they're used to all variety of news. And as a result, sometimes as a founder, you can always feel a little bit judged in sharing bad news with your investors, because you're always worried, how will they perceive it? Will they be happy about it? Etc. Etc. With us, they know that, look, the journey of building any company is a mix of ups and downs. And they also know that we don't really get too phased by some minor bad news, because that happens all the time in every business. So, I mean, from the outside, everything looks smooth and beautiful. But from the inside, the process of building any company is full of ups and downs every day.
Right. So I suppose there's a legitimate expectation of a greater degree of empathy and understanding from you guys. And this is also where, the operator and the investor hats become mutually self-enforcing, as Kunal was mentioning earlier as well. I think this is an interesting point to just pick up a question that someone has asked us, Rohit and Kunal. Because, I have heard you elsewhere also talk about how founders approach you. You alluded to it right now, Rohit, as well. And the question is, there are several funds and investors today chasing the best ideas and startups, and how will Titan Capital get the cream? Now, of course, to a degree, the question is answered in the design of the product, where we're looking at the winners that we are going to. But it may be worthwhile sort of just commenting on how founders seek you out. In a way, it sets the stage for future conversations on Titan Capital as well, and not just the winners fund.
Yeah, sure. I think it's a valid point and pertains to any investor, not just Titan. See, first and foremost, it begins with having a good reputation. You can hire the most intelligent people on the planet, but if as an investor you don't, as a business person in general, but I think particularly as an investor, early stage investor, because you need to have a tough stomach and and sort of a big heart in some ways. And if you don't have a good reputation, then the top founders are not coming to you. And word gets around very fast if you do right by founders, and word gets around very fast if you don't do right by founders. And because over the last 13 years, we've done right by founders, being founders ourselves, and as you, Shiv, used the word empathetic through the journey of the founders, I think Titan has a pretty decent reputation amongst the entrepreneurial community and the aspiring entrepreneur community, which is why, so that is one reason. Second is, the world of investing is such that if you are seen as an investor to be successful in making good picks, the subsequent cohorts of founders, entrepreneurs have a predisposition to go to investors who've already made successful bets. because there is a perception that there is something that that getting money from them, getting capital from them is an additional sign of validation because they've demonstrated some intellectual fortitude in the past of picking good companies. So, we've been seed investors in companies like Ola, Razorpay, Off Business, Mama Earth, Urban Company, Shadowfax, Bira, the list is long. And we've not been sort of like one hit wonders that like just one company did really well and we've been riding the coattails of that. I think we pretty much every cohort over the maybe last 3 years is too soon to claim any victories, but probably for the first 7 years of our investing, every cohort has, at least one, if not many winners. And that also is an attraction for entrepreneurs. Third is the community. With over 250 entrepreneurs, 250 companies and 550 founders in our community, because each company will have 2.5 founders on an average. This community itself is so powerful now that it helps each other. Because, Rohit, myself, our extended team at Titan, we are, at some level, we are only as many arms and legs and brains. But imagine 550, 600 incredibly smart, passionate, motivated, entrepreneurial talent coming together and helping each other for the smallest of problem statements. Hey, can you give me a reference of a CA or a performance marketing person? To, oh, my employee's gotten caught by the cops somewhere in the country. How do I get him out or her out? Like and everything else that comes in the middle, investor referencing, etc. So that just creates this network effect in the business, where good reputation, good performance, or good picking of founders, obviously helping founders succeed, and then the community itself helping everyone else in it. I think it's all of the above, but Titan Capital, people only started talking about it 2-3 years ago, but it's this usual, overnight success that took 13 years. So, we've been at it for a while.
Right.
But also, I think just in addition to all the things that Kunal mentioned, one big source of references for us, which is a very common pattern we've seen over the years, is a large number of the new entrepreneurs are actually people working at some successful startups today. Many of those startups we are already investors in. And as a result, they themselves have heard from their founders of who were their early stage investors, how they were helpful, etc. And as a result, the moment a VP of Urban Clap is leaving to start a business, we are the first people they usually call. Because they've heard from their own founders how helpful we were in the early days. So that way, I think even in the sort of middle and senior management of many of these at scale and successful startups, there is very good reputation and brand recognition for Titan because we've been at it for many years.
Indeed. And I think we'll come around to the question of, how well some of these investments have done in the 13 years that you've been at creating the success, the overnight success. But yeah, it's clear that you've created a virtuous cycle, with several aspects reinforcing each other, bringing these people.
That said, Shiv, I would also like to add that this is also a business where it's very easy to become complacent. Just because you had a few hits, you can start feeling that you have what they call the Midas touch in the investor parlance.
Right.
We are incredibly paranoid people. And it's very important to mentally condition yourself that, look, in the end, you're only as good as the founders that you've backed. And if something's worked out, it's because of the founders and not because of you and your picking ability. Because so many facts change between the time you invest and eventually at the time when the company has succeeded or not succeeded. So clearly, we can't take too much credit for it. And finally, I feel that one must realize that in the world of investing, it's not very different from the world of Bollywood, where you may have tons of hits historically. The last 2-3 years, if you've not delivered a hit, people will say, they lost their touch. So we are incredibly paranoid about not losing our touch. And that just requires, hard work, getting out there, talking to founders, helping the founders you've backed, and getting the companies to the other side of the river.
Sure. And I think there is something to be said for remaining consistent and playing your last bet the way you would play your first bet, which is a famous adage that people use. Of course, you have to evolve your process and system as you learn more and more, but certain disciplines need to remain long into the future as well. But this gives us a good segue into this question on the core of how we've titled this chat, which is about great founders. And I think, Kunal, I picked up somewhere you said that great founders build great companies even in the toughest conditions. And arguably, we've seen some tough conditions recently here in India. So in your view, more generally, what are the attributes of great founders and a successful business strategy? And we're just going to the core of this, the investing process, I suppose, to both of you.
Yeah, sure. So I can take a crack. Rohit can also join in. So look at the earliest stages of the company when we are looking at investing. Largely, three attributes matter the most. One, the quality of the team. Have they demonstrated success in anything in life? It could be as a job, at a prior business, dancing, singing, cricket, anything. Because to be successful at anything, you require a level of intensity, which is very critical. And entrepreneurship is an incredibly demanding and intense endeavor to pursue. And so knowing that this person can bring really, really strong intensity is very important to us. It doesn't have to be in only professional or an academic setting, but more often than not, the markers are academic or professional that we would look for. The second is the quality of the space, right? We are not looking, unlike many venture capitalists where they'll talk about we are going up, we need to see large TAMs. We are actually diametrically opposite in our thinking. At the earliest stages, we look for what we call laughably small TAMs, where these are really narrow slivers of otherwise very large markets. Because with the amount of capital at the end, the resources and the headcount that a founder will have, they can at best dominate a very, very laughably small TAM in a large market, because they will not be able to compete otherwise with larger incumbents. And once they are successful in that narrow sliver, then they can slowly grow their TAM, because now they build fame and reputation and love for the brand. Giving an example for this would be like a Mamaearth, right? Like when we invested in Mamaearth, I think they were doing, I don't know, 7 lakhs of sales a month. They had just launched. To put it in perspective, they now do, I don't know, whatever the last publicly listed reported numbers are, but my sense is 200 plus crores a month, right? So we've seen the journey. We are still shareholders. We invested in their seed round and we continue to be shareholders post their listing. But at that point in time, the only product they had was really a mosquito repellent, which was organic or good for you for children, right? And they had like a shampoo that had just launched, etc. So just a couple of products. You would call that a laughably small TAM, because just the entire mosquito repellent market in India total was 700 crores back then, right? Of that, they were focusing only on children, and within that, they were going after a slightly more premium, non-toxic product. So like the TAM maybe 50 crores. But they had a very unique product, and they had a good product, and they had a product that consumers loved. And from there, they built fame and reputation and expanded categories, and rest, as they say, is history.
I think going along with it is very important to have in that small TAM an absolutely exceptional product. At least we've seen over a period of time that having a very large TAM but a marginally better product doesn't really get to anywhere, because switching cost for a customer is too high. For a marginally better product, people usually don't want to switch, etc., etc. Whereas if you build an absolutely exceptional product in a small TAM, that you're able to win very large market share in that small TAM, and then that brand love and reputation that gets generated, it's easier to replicate that across different TAMs and grow the TAM over a period of time, versus just keep waiting for people to adopt a marginally better product.
And I think this is a very interesting point because, sorry,
So
go ahead.
coming back to I think the 2 points Kunal mentioned, and the third point, which is extremely important to us from very, very early days in a business, even from from the stage of when the founders are making their PPT to present to us is being able to visualize generating healthy unit economics from the business, because that's absolutely essential. Given the stage at which we see businesses, many founders have absolutely no clue how to make money. And some of them come with this very fancy notions that, we will build the business right now and at scale, we will be able to materially change our unit economics. We do not belong to that school of thought. We are very clear that once you scale the business, fixing unit economics, if anything, becomes even harder. And as a result, there may be some minor tweaks you can make in your margins, etc. But by and large, they stay in a similar zip code as they were when you started the business. And for us, it's extremely important to see from day one how the business will eventually generate profits. First, making healthy economics, then becoming profitable at an overall level. That just is a sort of deal breaker, make or break to us.
Right. So great. Thanks for sharing that. I suppose the last 2 years have helped to strengthen the arguments of people in the camp of sensible economics versus other fancy styles of generating scale and growth, and then thinking about these things afterwards. I just had a question on the TAM point, right? It's a very fascinating point where you're looking at a very focused, narrow sliver because it introduces an idea of focus and an idea of founders thinking about what products people will actually love, right? And something that you can do. But at the time you choose that focused sliver, as you mentioned, is there still a sense that what you will do to make this successful obviously has the ingredients of something that could address itself to a larger market, more categories and things like that? Is that something you do think about at that time? Because then that would point to a larger TAM, right? If you then categories and how do we take this idea and extend it here and there?
Generally we've seen, Shiv, if the first box is checked, which is if it's a great team, and the second box is checked and the third box is checked, which is team quality, clearly defined TAM and focus, and third is unit economics. We have almost never seen the founder to not find ways to grow the TAM. The best founders always figure out a way to grow the TAM of their business.
Right.
We are yet to see a data point where they were not able to do it. Like we've never seen a great founder who's dominated a sliver of the market with good unit economics come to us with his or her hands in the air saying, I really can't I can't really figure out how to grow the business from here. We are yet to see such a person.
It's logically unlikely to follow if you've got these three things right.
Whereas the other two we have seen enough examples of. So as a result, we are conscious about backing smart people, but we are also extremely conscious about the bet we are willing to take and the bet we are not willing to take. We are willing to take the bet that over a period of time, as long as the economics work and the first product is exceptional, the founder will be able to grow the TAM. We are not willing to take the bet that the founder is saying, well, my economics look horrible right now, but 4 years later, I will fix them. That bet we are unwilling to take.
Right.
The smart founder.
Quite wisely, I would say. There is a question, and a little bit you alluded to how you help people in different myriad ways. But there was a question on, what are the most common challenges one of our clients is asking you see founders face at this stage? How do you help them think through this? And I would just add on to that another question and combine the two, because I already fear we'll run out of time eventually. Is that, to persist or to pivot is a dilemma I'm sure many founders contend with, right? With certain ideas. And you at Snapdeal, I think you persisted also, you pivoted also in part. So how do you advise founders to think about this? Is there a framework to apply? Is there instinct? So again, what are the problems most commonly faced at this stage that you see? How do you help them think about this? And of course, if this is one of them, then maybe you could comment on this too, Rohit and Kunal, whoever wants to have a crack at it.
Yeah, we feel that at the early stages, Shiv, which is what we focus on, there are problems that you face at different types of problems you face at different stages, which we can also talk about because we ourselves as founders and operators have experienced the same as well as in our portfolio companies. But at the early stages, generally many of the problems are self-perpetuated. where there are problems of lack of focus, usually problems of lack of focus on unit economics, problems of overspending and overhiring. These are generally the problems that don't allow companies to get from zero to one. And then once you're at one, then different types of problems. Now, customer satisfaction comes in as another problem statement. How do you get from 1 to 10 in terms of growing the business becomes a problem or challenge. Hiring the next orbit of talent becomes a challenge. And then from 10 to 100, it's basically magnified versions of these problems that you start seeing. So with phases, the problems change, but at the early stages, it's actually purely internal. It's very little to do with the market. Unless you're in a very regulated market where regulations are changing, we generally stay away from such markets.
One of the common problems, you'll be surprised to hear, Shiv, we've seen, especially once you start generating some revenue, is also the problem of extremely high short-term ambition at the cost of long-term ambition. What I mean by that is, there's this popular narrative which is taken hold large parts of the startup ecosystem that growth should be 10x, 100x, etc., etc. Look, we've been investing for 13 years. Even in the most successful of businesses, we have never seen a single company being able to grow 10x year on year. It just doesn't happen. But there is this very at scale, almost propaganda-like noise around that, which many young founders get carried away by. And as a result, they start thinking and believing that if they're not growing 10x, then they're doing something wrong. And usually we've seen that type of growth comes with extremely, extremely horrible economics, to the point of the company draining itself of resources very, very early on. So actually, one of our big areas of focus, one of the big sort of problems we help companies solve, once they start generating some revenue, have some traction, and now are sort of starting to grow, is to keep their ambitions more long-term in nature. Look, here, 3 saal mein, let's plan for 7x, 10x, etc., etc. But for a year, as long as we're able to grow 2 to 3x, that's absolutely phenomenal. But the more important thing is to be able to make sure our economics stay a certain way. Keeping the economics a certain way, we should grow as much as we can. There's no problem. But at the cost of economics, being able to sort of feel happy about delivering 5x, 10x, etc., is completely useless, because we've always seen those curves come down very rapidly in the subsequent years. So in some ways, helping them reframe the sort of the time scale of their ambition also is a big area where we spend a lot of time with the early stage founders.
Well, it's fascinating, but not surprising. But reframing the goals is obviously a very effective strategy in so many different circumstances. And here it looks like it applies to these situations quite directly. Look, we live in a noisy environment anyway, and amplified by internet and social media, and many times amplified from people within the industry. So it's not surprising, right? Because you will have practitioners and participants in the industry, arguably people who could serve as mentors, etc., sitting in investors' chairs. And it might sound like a controversial point to make, but many of the times these people are driving some of these expectations. I'm sure you'll agree with me at some level. So
yeah, and I think that's where one of the other things which, it's a small but very important point from a mindset standpoint. Whenever we invest in a company, we actually think like business owners of the company, because we are investing at the earliest stages in the business. When we invest, we keep a very, very long-term horizon in mind, that look, what does the business need to look at maturity? There'll be some ups and downs in between, which we will navigate through. But true enterprise value creation and true value creation, even for ourselves as shareholders, is only going to happen if the business looks fantastic at maturity, when it's planning to go public, etc., etc. And we don't have the mindset that where is the next round coming from, and how can I mark up my investment for the next round. The decisions you will take with the latter will sometimes be extremely different from the decisions you will take when you are the former. As a business owner, let's say we meet a company after 3 months and we realize that some parts of the company's revenue are toxic in nature. They don't have healthy economics, and long term they are unsustainable. we would actually actively advise the company to cut out that part of the revenue, knowing fully well for the next 3 to 6 months, actually, it may look like the company has not grown or degrown, but will make the company healthier so that post that the company can grow with healthy economics. Whereas, an investor who's looking to trade shares up in the next round may actually never be able to advise that because they're always anxious. How does it look to the next story we need to tell? So we actually absolutely don't think like that at all.
Understood. Sorry, on
For
that.
us, we are trying to fund lasting, enduring businesses, right? We're not trying to trade on shares of companies. We're not trying to find arbitrage that, let's get in cheap in this company so we can sell at a markup, 2x, 3x markup in the next round. That's just absolutely not how we think. We are thinking that, do we want, like Rohit said rightly, do we want to own a piece of this business? Do we want to become part owners in this business, which we can own for the next 5, 10, 15 years, however long it takes. And then all our advice is also very much aligned with the founder because the founder is also in it for the long run.
Yeah.
And automatically a higher quality company with stronger foundations gets built. And by the way, we were not born with all this wisdom. We've also
learned it the
learned
hard
all
way
this.
in some cases.
By the way, we have battle scars all over every inch of our body. So we've also learned all these things the hard way by making our own mistakes. Unfortunately, we didn't have a Titan Capital when we were setting up. I think we would have made a lot more progress, a lot more capital and time efficiently if that were the case.
Well, some of these questions link into questions about the fund. I wanted to come to the fund last. I just wanted to cover off a couple more questions and then we will come and talk about some of this. Ironically, though, from what you just said, Kunal, that the approach of just finding good businesses that look good in the end, based on certain assumptions, should end up providing the best returns also. So in a way, it's if you're focused on return and not in a 2-3 year time sense for the next fundraise, but slightly longer term, then you ought to get better returns like this. I would like to think. On that persist versus pivot point, just if you could just touch upon that for a minute, because we hear both of these things quite a lot. And
that's a tricky one because we've done Rohit and I've done more than a few pivots, but it largely stems from having an absolutely innate feeling that failure is not an option. Right, you first have to believe as a founder that failure is not an option. I don't think Rohit and I ever in 17 years of building businesses felt that failure is an option. We just, okay, this didn't work, no problem, we'll change. We'll find another way, no reason to be disappointed, right? And we just change and then we move another direction. And if we have to change again somewhere down the road, we will change again. And we live in an incredibly dynamic industry, which is the world of technology startups and technology in general. You have to have that type of mindset. You have to have strong opinions, but held loosely. You can't have this much attachment to your idea, your business, the current business model, because the market's moving. Your market's not stationary as time is passing by. And so at least, if a founder believes that the goal is to build a successful company in the long run, whether it is in this current business or not is not really that relevant. That's the starting point to actually having an open mind to pivoting your business. But oftentimes we find founders who are just very pig-headed about the fact that isi ko chala ke dikhaunga. It's good up to a certain level, but there's a fine line between resilience and stubbornness. And many times they do cross over to stubbornness, which actually ends up being value destructive because if you have capital in the bank, and the current thing is not really working, you've given it your best shot, and your well-wishers around you are saying that, look, it's not really working. It's okay, this product or service is not finding product market fit. We still have enough capital in the bank. We can still find another business idea. We'll work with you to identify another opportunity. Let's build in that.
Yeah.
And many folks have done that successfully. By the way, I don't think Rohit and I would be here today if we didn't have that mindset. Most people don't know now because enough time has passed. We started as a coupon magazine. like nothing to do with technology. From coupon magazine to e-commerce to software to brands to investing. At some level, we've always had this mindset of, we are survivors. We'll keep figuring out ways to keep moving ahead.
But I think one of the other things we've seen, Shiv, is, on that specific topic, given the nature of founders we work with, who are generally very intense, very hardworking, will always want to keep figuring out a better way of doing things. We've seen that usually it is a lot more obvious to the investors that they need to pivot before it's obvious to the founder. Because when things are not working out, an investor is, at least like people like us who've been doing this for some time, are usually able to tell, look, these guys are putting in all their effort, kuch ho nahi raha hai usse. And as a result, it may be actually better to direct those efforts in some other direction so that there is something that can be built of value. More often than not, we've seen founders take it upon themselves almost as a challenge. Ki, nahi, look, how can it not work? I will make it work. I'm not working hard enough. I will work harder, etc., etc. And as a result, a lot of the time, sometimes, it's about having that chat with the founder that, look, we know you've been at it for a while and you still feel it can be made to work. And it's always a sort of progressive problem, right? That, okay, I know in 2 months it'll be okay.
Yeah.
I know I have the next ideas, 2-3 months mein theek ho jayega, etc. One of the frameworks we've seen work is because almost all founders are in that state of mind before they need to pivot. One of the frameworks we've seen work with founders is we ask them to draw a hard timeline. If you think it'll work in 3 months, no problem. You take 3 months. Then take April 30th, 2024 as the timeline. If things work out by then, great. Otherwise, on May 1st, let's start working on something new. So that at least they stop treating things working out like a moving target. And know, okay, by this time, if things don't work, then it's probably good to pivot.
Sure. Now, this is fascinating because, in behavioral finance, you have these terms, these biases. One is the sunk cost fallacy, and the other is the escalating commitment to a failing course of action. And as investment managers, we see this all the time, even in the work that we do with investors. And I can imagine how intense it must be with founders, because at the root, it is that you don't like being wrong, right? And you get emotionally attached to your ideas. And it's how to get people out of that, and using the framework that you mentioned, Rohit, for example, a time-based thing. Maybe think from first principles, re-examine your assumptions, be as rational as you can, I'm sure. But thank you for sharing that on this pivoting question. It must be still the hardest problem for a lot of people. I'll move on slightly to, your success as investors, right? To the fact that you funded 250 plus, I guess, businesses. And I understand that only 15% have been written off as against what looks like an industry average of 33%, right? I'm assuming that this is mostly reliable.
Yeah, I mean, actually, this is the type of business you should spend more time on the winners than the losses, because by the nature of very, very early stage investing, you will have a high loss ratio. That's, approximately 50% of generally in the seed, like pre-seed, stage of investing, give or take, about the industry data is about 18% companies end up raising the next round of capital. In our case, it's been more than 50%. So it indicates that there's some bias towards picking companies that have more legs, right? At least in the idea, the team,
Sure.
the ability to generate unit economics, than at an industry level. That said, at the pre-seed stage, that what we've been doing for now 13 years, there is going to be a decent number of companies that won't work out for a variety of reasons.
So Kunal, if I
That's
may
okay.
sorry, I'm interrupting you, but my question was going to be that your failure rate looks like half that of the industry. And I was just going to go on. So it wasn't really the fact that, there are failures. Of course, there are going to be failures, but is there something in the process is there anything notable in that statistic? Or all the things that you've been talking about kind of explain that already? And I'm just going to go on and make a larger question, because I think you could address them all together, which is that you also have an IRR of 155% realized IRR on your Titan Capital, which is high by all standards. So, I mean, we want to give our clients some insights into the composition of the returns, if there is something to attribute to the low failure rate, for example, is there something there or it's not a thing? And just sort of,
Yeah.
just
Fair. So
why
look,
you think it's been so good or so high.
yeah, I think Shiv, I think some of the principles we outlined, where it is one thing knowing the principles, or we've been talking about these principles for years in public domain. Like, we're not sharing some secret sauce today. I think we've written articles about it. We talk about it on public forums and podcasts. Like, actually, Rohit and I are short on content. We just keep saying the same things wherever we go. And so the problem is that I think, or maybe I should not say the problem. I think maybe the good thing with us is we've been also disciplined enough to follow the principles. The principles we feel are cogent, but following the principles with patience, resilience, and endurance over a long period of time is really what allows you to repeat success in an otherwise investing segment that doesn't feel like you can repeat success, right? That's one. On the So anyways, Rohit, you want to add something
No,
on this one?
I was just maybe only going to say the same thing in some ways that, look, talk is cheap and everyone has principles. There is no investor who doesn't have principles. It's just the harder part is sticking to them. And, sticking like a couple of principles which we didn't talk about are also, we are very clear about things we understand and things we don't understand. What I mean by that is businesses which have no economics today, where monetization or revenue will happen 3 years later. Deep tech business, some content business, which can't be monetized today. They are great businesses. We just don't have a feel for them. And having the having the sort of gravitas and staying power to stay away from those businesses, even when they are the hottest ones in the market, is an important parameter in decision making. Like, we've seen that in some really frothy markets, we've actually looked very conservative as a result. But that comes from the place that, we have a certain set of principles and we want to stick to it. We update them over a period of time. But when we have a certain set of principles, just even in times of acute FOMO, we will not feel FOMO. And
Maybe
it's
sometimes it's in the times of acute FOMO, you ought to even double down on those.
absolutely. And I think not being able to avoid FOMO is one of the biggest superpowers as an investor. Because a large chunk of the investing mistakes we've seen over in our investing career, at least, happen because of FOMO. And it's again, as Kunal mentioned, we were not born with it, but that is something that we've acquired over a period of time, having seen a few cycles.
And you have the battle scars to prove it. Well, Kunal, I should just say that, repeating the same thing over and over again over years puts you in the same camp as Steve Jobs. So I think that's a pretty good situation to be in.
Yeah. Well, I think I was looking at one of the questions about the 250 companies being spray and pray. Actually, it's a good point that someone's mentioned. Firstly, I think it's over 13 years, it's 250 companies. So, which is, maybe 15, 20 a year, which is an okay cadence for an early stage investor. I feel that if you're doing less than that, you maybe being a bit too sharp shooting for this segment of investing. I would not advise anyone investing in one company or two companies a year if you're doing very early stage investing. Chances of missing some secular waves of, not as in like funding waves, but waves of industry creation like e-commerce or payments or ride hailing, like which are secular trends which become enduring industries over time. Because if you do too much of a plucking, you'll just miss that, and nobody's that smart to find every possible time, find every possible trend. Secondly, I feel I would agree that at the end of the day, the number of companies don't really mean much. In the end, what matters more is the companies that do work out in the portfolio. And all said and done, this is a power law business. This is not public market investing where you'll see a narrow band of returns where maybe from, I don't know, 5 to 15 or 5 to 25. Here it's 0 and maybe like 100x or 200x. So the band is very, very vast. So obviously a lot of the returns are driven by the big winners, but usually, most good investors would not be one hit wonders, right? Because then I would be concerned. But thankfully, I think God's been kind. And our team's done a good job in identifying many winners across cohorts. But we absolutely don't ascribe to the spray and pray. We feel that that just shows that you don't really know what you're doing.
I think it's very important, as Kunal mentioned, to keep a fine balance. One can't be spray and pray, which we absolutely are not. And hopefully, the last 45 minutes of conversation would in itself have sort of demonstrated some of our thinking process, which automatically will filter out a lot of stuff. But at the same time, knowing fully well that this is extremely early stage investing, is also a business of asymmetric upside, where the downside relatively of each company failing is lower, whereas the returns that can be generated can be very high. And look, at such an early stage, there are many, many, many unknown risks in a business also, and one can't not be cognizant of them. Founders not liking each other, ending up fighting with each other, something about the space absolutely not being acceptable to consume. I mean, there are so many things that can go wrong, which is why this is early stage investing. And as a result, with the best of judgment, best of abilities, best of wisdom, you can at best have a higher success rate. But this is not a mature stage industry where the company is already generating a certain amount of profit, has a 5-year history of growing profits, and hence will continue to generate, which is why these companies are available at the valuations that they're available. If they were already profitable for 4 years and sort of growing profits over 4 years, which means they're sustainable, they will be a lot more secure and there'll be a lot less mortality ratio. But then why would they be available at materially cheaper prices than what is available in the public markets?
Sure. Well, thanks for that. I think we'll just turn to the winners fund itself a little bit. From Titan Capital to Titan Capital Winners Fund. Maybe if you could share, Rohit and Kunal, your thinking behind launching the Winners Fund, right? Given that traditionally you've not done follow-on rounds in some of the investments as well, and obviously there's some difference in thinking on this one, and it's a narrower list or set of companies. Of course, the term winners itself describes what you're thinking at one level, but also in a structure which has some constraints as well. So what is your thinking behind launching the Winners Fund? And then we'll get a little deeper into some questions that people have asked here and before on managing exits and also on managing conflicts.
Sure. So, look, we've been investing in the pro rata rounds of many of the companies that we've invested in historically. And what we realized is the returns we've made on the pro rata investments, the IRRs of the pro rata investments, are almost equal to the IRRs of the first check we wrote in those companies, the seed check. And the reason obviously mathematically, the mathematical explanation of that is that the seed stage bets have higher loss ratios that offset the IRRs of the winners at the seed stage. So as a result, the IRR equates across the seed investment as well as the pro rata round investment in the same companies or in the same set of companies. So so we've been doing this with our capital for some time now, for 13 years. But about 4 or 5 years ago, a lot of folks started approaching us saying that, why don't we want to invest alongside you? You guys have good access, good eye for these companies and helping them. And we've been noodling about that for a few years. And then finally, last year, Rohit and I decided that we should put a vehicle together where nothing changes in the way we approach things. The same high bar. We didn't do pro rata in all the companies that we were seed investors in. We continue to have a high bar. There were rounds that we will say it's too expensive. The company hasn't made as much progress, irrespective of however pedigreed the incoming investor may be. We would skip it. We may do the subsequent round. or we may do this one and not do the next one. We would be completely flexible in our approach with only one thought in mind, that is the risk reward ratio in favor of making the investment at this point in this round or not at this price. And so that's how we came to this idea that let's create this vehicle where we'll anchor it, we'll put the largest check in this vehicle ourselves. So the interests are absolutely aligned. And we will only invest in the winners, select winners of our seed portfolio, where companies that are making good progress, an external investor is coming in, diligencing the company completely independently, pricing the round, and we are essentially participating by writing our pro rata check or our super pro rata check. We would not, and we were very clear, and this maybe addresses the conflict point, that we were very clear that we would not bridge our companies, we would not lead rounds, we would not price rounds, we would not be the largest check in any of the companies that the winners fund is investing. Also, we were very clear that the winners fund, if the winners fund says no, we would not invest from our personal book either. And also the winners fund would not buy any equity in these companies from us.
So honestly, I mean, in some ways, Shiv, we had realized that there's a big opportunity a few years back because the amount of capital one can put to work in pro ratas is much larger than also much larger than the amount of capital we can put to work only in seed stage, while generating almost a similar IRR, which is what we had seen over the sort of 10, 12 years of our investing career. We wanted to do this, but one of the big things which was running in our mind was also, how do we make sure we structure it in a manner that while we know we are doing it with the right cause, but we structure it in a manner that it sort of has the right conflict guardrails in place to make sure it gets read as having the same intent that it actually has. So the most amount of time, even while our filing our PPMs or setting up our fund, etc., the most amount of time we actually spent was not in figuring out how to go after select companies, because we've been doing that for many, many years, how to sort of decide investment, etc., etc. The most amount of time was spent in actually figuring out how do we make sure we communicate effectively, how to avoid conflict. And that's, I think, the key tenets of which, as Kunal mentioned, are actually a part of our fund structure itself, where what are the common conflict points possible, right? The fund can't buy existing stakes of businesses, right? So the fund is not a vehicle to give us an exit. We are ourselves the largest anchors in the fund anyway, so there is absolute alignment of interest. We ascribe the pro rata rights of all our investee companies to the fund exclusively. What that means is that if a company is coming for a pro rata, the fund can invest or not invest, but we can't invest either. Which means that if it's not good enough for the fund, then it's not good enough for us either, right? We won't price the rounds of incoming companies, which means that this is not an instrument for us to mark up our own investments, which is why we've consciously decided that we will not lead any of the rounds in sort of these companies. So these are sort of some of the key tenets as comprehensively as we could think of, which we've set up from sort of the very get-go of the fund.
Yeah, thank you. I think these are a comprehensive set of measures. And I just want to say for some of our investors on this call who've been asking this question and who are considering investing, that these have been explained in detail, listed and explained in detail as well in the fund material. So we would encourage you to go through them again. And then if people have any questions, of course, they can come back and talk to us. But thank you for sharing that. It helps to hear it from you. Just on the fund now, from an exits point of view, so there is this question that some people have in their minds, that AIFs come with some finite timelines, albeit it's still quite a long way. But does that impose any sort of a constraint? Is there a different way that you might have to think about some exits, for example? Would you like to just comment on that?
Yeah, look, we've been, one of the challenges in the particularly VC AIF asset class, because Rohit and I are also LPs in many funds, is just the lack of liquidity. And if there's one thing we've been very disciplined about in Titan, because I don't know how many people on the call caught the fact that you said that the IRR for Titan has been 60% plus realized, not unrealized. So, which means that we've been disciplined about also partially or completely exiting positions whenever the opportunities have come. Yes, we are long-term believers of the founder and the business, but we have to also keep managing the risk in the investment and not get too greedy as well. So, when a company's value has run up a lot and our holding is now run up a lot, we usually will start taking some chips off the table. But we'll never sell all of it unless the company is getting sold. We'll usually, in a particular opportunity, sell 15-20%, and then let the rest ride. And then at the next opportunity, we'll assess again. So that's how we've been approaching it. And at least in the case of the fund as well, uh, firstly, why we want more time is because we feel that in India, to build large businesses, it takes time. It takes longer than anyone always says. If people think it'll take 4 years, it takes six. If they say six, it's eight. If they say eight, it's 10. Everything takes a lot longer. And at the same time, 80% of the value creation happens in the final 20% of the time. We've seen that in company after company after company. And if you exit too soon, that significant growth in value in geometric progression that happens towards the end, because by then the company is established as a category winner and is getting tremendous amount of value creation, because then they're benefiting by being the leader in the market. A lot of early stage investors sell by then, and then they're not able to enjoy the upside, and also upside commensurate with the massive risk that they're taken by coming in at the early stages. So both things are important. One is obviously not getting too greedy and taking your partial chips off the table. But at the same time, what is also critical is not to be too hasty in exiting positions, because if you are if you are on the cap table of a company that's clearly turning out to be a category leader, there is tremendous value creation that happens in those companies.
No, and as a result, we are also very clear that look, while we keep optimizing the risk reward over a period of time, and after a certain stage of company, we will keep taking chips off the table, so that to make sure, which is what we've done all through these years as well. But we also want to make sure that people go in with their eyes open into the fund, that this is not a three-year instrument that, come in, invest, get liquidity in 3 years. This is not that instrument. And as a result, there was a lot of push to us. Why don't you shorten the period? Why don't you start generating returns sooner, etc.? Look, we will do that when the need arises and whenever there's an opportunity. But we don't want to go in promising or setting the wrong expectation with people that suddenly in 3-4 years there'll be a lot of liquidity, because just practically we've not seen that happen, because even though it's a winners fund, still the stage at which we are investing in companies is a series A plus type stage. And as a result, they are still extremely early stage companies. And we've seen over and over again that it takes many years to build a business.
So I suppose
it's taken a few years, then it actually doesn't make sense. Once the business has started working out and is in growth phase, then the value multiplies very rapidly over the next few years. And selling too early is one of the biggest mistakes we could have made.
Right. So I suppose I guess the point simply is that you have enough time in the structure of an AIF to allow you to realize value for the most part.
Yeah.
And that is what we want our investors to know as well, because some of them are thinking that in fact the opposite may be an issue. But I think you've addressed that. You obviously will find a balance between taking chips off where you think they should and letting a category leader kind of trade run to realize maximum value. Can I just shift a little bit? So I think we've talked about the fund a fair bit, and we've made details of the fund available to potential prospective investors, and happy to have offline chats with them as well. Just a little bit on the environment, people have been asking. It's a more general interest point that, talking about the funding winter, is the ice starting to melt? What are the big things happening on the ground in terms of deal making, fundraising, and how businesses are coping with it? And how should we think about valuations maybe in the present environment?
Honestly, we haven't really felt the funding winter as such, right? And I think that's because of our natural bias towards not investing in cash guzzling businesses.
Hmm.
And the fact that our businesses, we are on a monthly basis, we are tracking the MISs, we are tracking runway, we are tracking burn, and we are intervening well in advance, right? Not when there are 2 months of money left, because then any amount of intervention is the only intervention then you need is more money, right? No other intervention in the business will really help. So, at least from our standpoint, we haven't really see at the early stage, the market is vibrant. There's a lot of domestic capital at the very early seed, pre-seed level. The Series A, B investors have raised $5 billion. They have been slow to loosen the purse strings, but for the right businesses, there is tremendous amount of interest. Where things have palpably slowed down is the very large growth checks, those 100 million plus checks. Those have completely evaporated, it seems, for now. Largely because the writers of those checks are taking a pause in general, maybe not just in this market, but in general. And if you look back in 2021, which is the height of the funding, summer, if I may, there were literally like 5 investors who were writing all these 3-digit million checks.
Right.
And it was just them then, and it is just them absent. It was just them writing the check then, and it's just them being absent now.
Right.
Nothing else has materially changed in the ecosystem as such. I would even argue that more domestic capital has come in to take in their place at different rounds. Even at the larger rounds, we are seeing a lot of family offices come in for pre-IPO rounds and writing maybe not $100 million checks, but at least a few 100 crore checks. So we are not particularly bothered, to be honest. And from here on, things will only get better. We feel partly because India is seen as such an incredible macro bright spot right now. All the global LPs, like every day, I'm getting like emails from LPs who are in India, who want to like global large endowments, university endowments, pension funds from the West, who are in India, who want to understand what's going on here. Everyone is allocating more capital to India. And we'll start seeing that because the managers are raising, it'll take them a year and a half to raise, and then they'll start deploying. I can only see the trajectory go upwards from here. So we don't particularly, neither do we fund businesses that require an enormous amount of cash, because that means more dilution for us, which we don't like. And neither do we feel that there is such that the market is parched for capital.
And honestly, to some extent, given our mindset on the kind of businesses we like, this type of environment actually helps a lot, because the surround sound around the entrepreneur is also not telling them to grow at all costs. We anyways are broken records on that front. Like for the last many years, that whenever we meet an entrepreneur, we actually would very sort of strongly advise them to have healthy growth. But it helps when the surround sound is also like that. And certainly it seems we are more in line with the current trend of the market also. So from that standpoint, it actually helps the founders in some ways. And as a result, we are actually seeing companies are becoming profitable and growing at much earlier stages now than they used to till 2 years back, because till 2 years back, the overall surround was growth at all costs, which wasn't healthy for businesses in the long run. But I think this current surround environment is helping them build businesses which are more enduring, more self-sustaining, and overall generally a much higher quality overall.
I think some discipline is always good for the development of the market overall. And the theme coming out of all of this is think long-term and focus on the fundamentals. Of course, the idea that India is in a macroeconomic sweet spot has continued to get reinforced, progressively. And I think we're also in an environment where interest rates are not where they were 2.5 years ago, which was E factor to a degree, I suppose, which was also influencing wild swings in capital markets, all parts of it, including this.
I think, Shiv, one thing to keep in mind as to how we think about what kind of businesses we like. We like businesses that can become profitable as quickly as possible. So we don't ascribe to the philosophy that let's get to a certain scale and then we'll become profitable. We are like, if you can become profitable, if you're already profitable, we love you more, even before we have invested. And we would be like the next best outcome is you becoming profitable only with our money, right? So we are always looking for the path of least time, least money going into the company for the company to be profitable, because then you have absolute freedom. Then you can raise at your beck and call. You can dilute as per your expectation. That's where massive IRRs are created, right? The big problem in India has been you have had these multi-billion dollar valuations, but the investors have not made much money because the dilutions have been so incredible that you are much better off entering a company at a 50 crore valuation and exiting at a 500 crore valuation and hoping the company didn't raise much money. You would make far greater return than maybe being an investor in a unicorn that raised 500 million.
Right.
No, I think that from that standpoint, look, from our experience, Shiv, the way we advise businesses that we work with is to maintain the X factor and innovation of a new age business, but actually learn their best practices on cost management from quote unquote traditional Indian businesses.
Yeah.
Because over and over again, over the years, we've seen, Indian companies have done an absolutely exceptional job at managing their costs and managing their economics. And actually, there's a lot to learn for the startup ecosystem from that, because look, while a lot of the revenue and a lot of the glamour sits in the startup ecosystem, a lot of the profits still sit in the traditional sector.
The traditional business. Well, I should tell you, sorry, I think I'm interrupting you. I'll let you go ahead and then I'll tell you, give you an insight.
So we actually very strongly advise them that, look, maintain your innovation and, your smart people, maintain your X factor, maintain your innovation, focus on technology, but go and sit with traditional businesses to figure out how to manage your costs, because the combination of these two is an absolutely deadly combination.
So we are wealth managers. We have 1,200 families whose affairs we manage. Most of them are entrepreneurs, and we've been dealing with them over a long period of time. And many of them, at least up until a few years ago, were traditional businesses, right? Traditional business houses, business families, owning small to large businesses. And we tell our people to study the fundamentals of business from these people in terms of just maintaining discipline around costs, understanding where you can add value, where is your edge. So there is a lot to be learned from these people is the point I'm making. But like you said, adding that innovative dimension or innovation dimension then creates a deadly combination. Look, we're going to be out of time we have about 15 minutes left. We had asked some of our clients and staff for fun questions they want to ask Kunal and Rohit. And I think
now we are going to be completely out of depth because we are totally non-fun people.
I don't know. Let's try. We
can talk for 3 more hours about investing and entrepreneurship. I think about fun, I don't know. Maybe we a short conversation.
So we got 20 questions, but I think we picked out some thoughtful ones. In fact, we'll see how many we can get through. Maybe we'll have to be a little disciplined around how much time we give each of them, but they're actually quite straightforward, good ones. I'll start with the first one, and Rohit, Kunal, whoever wants to take it. What happens? So this is a question from actually one of our senior staff. What happens when you meet awesome founders who don't have great business models or their ideas appear ahead of their time? Is that a thing? What happens?
Look our instinctive reaction, while every case is different, but if I were to try and generalize, our instinctive reaction would be to guide the founder and wait for the founder to come up with a good idea. Because we've seen there are many exceptional founders, but when we are investing in a business, with our eyes open, we find it very hard to invest in a business which we don't believe in. And as a result, while there's obviously a lot of narrative around great founders, which is what we like as well, but we don't think just great founders with a terrible business idea is an investable situation. So we would actually actively guide them, work with them, hope that they change their mind, etc. And when the business that they're presenting makes sense, only then will we choose to invest. Otherwise, it's as good as finding any two smart people and telling them, start a business, here's some money.
Sure.
So we actually won't.
I mean, it fails on one of the three key elements of your framework in any case, or two maybe. But I think the idea is that do you stay in touch with them? Sort of, I guess the subtext here is that you stay in touch with them because you think that eventually they'll hit upon a good idea and so
But
on.
not as an investor. As an investor, we
Yeah,
want
as
to
a,
stay in
as a
touch with
friend.
them when we like the business also.
Yeah, quite right. Quite right.
Our
Kunal,
philosophy, Shiv, is like when in doubt, don't invest.
yeah, sure. Okay, I'm going to the next one. What's one startup or technology trend that you think is wildly overrated? And maybe one that you believe is criminally underrated?
I think criminally underrated is the value of focus.
Yeah.
Like there is always this desire to, spread your bets inside an early stage startup. Let's do 3 projects. Let's have 4 products, etc. That is usually a tricky position to be. You have to pick your bet and put all your eggs in it. Just the resources aren't enough to do many things. You got to do it with a very lean team. I think in terms of so that's underrated. On overrated, I don't know. Like at any point in time, there are things which are overrated in the world of tech. We at least, the Web3 world to us seemed highly overrated when it was hot. We kept out of it. Like Rohit and I have never bought any decimal of a Bitcoin or never invested a rupee of our money into any of these cryptocurrencies, etc. So we like Rohit earlier said, we just focus on our circle of competence. Like there may be other interesting things, whether they are overrated or underrated, time will tell. But if we don't understand it, we don't get close to it.
Yeah, I think one of the other things I alluded to in the past, sort of somewhere in the conversation, Shiv, which we think is extremely overrated, is this concept of 10x growth. It's the narrative is all across as a surround, but practically we've not seen a single company being able to exhibit that without poor economics, and also not having to materially correct its business in a subsequent year. And as a result, we are a lot stronger believers in consistency of growth over a certain period of time versus high intensity for short periods of time.
Sure. I think the point of long-term and strong fundamentals just keeps coming through, through the whole conversation, and that's at the core of
I
it.
told you we are very boring people. We just keep saying the same things again and again.
I think see, the point is that we keep saying these things over and over again, yet people do other things. So there is something to be said for that, right? Okay, imagine you could go back in time to the day you started Snapdeal, right? What advice would you give your younger selves? And this can go along with the question someone had asked on the chat as well. It is, what have been some of your biggest investment mistakes or lessons learned?
Well, I can think of one which is very, very obvious. I remember when we started the business, as Kunal mentioned, we started as a coupon booklet business. And both of us were, we had worked only for a year each before we did that. We went to decent colleges, but then we really had no work experience per se. And both of us, when we were planning the business, it was such an echo chamber that we were extremely convinced that the product we are working on is exceptional. We spent a year collecting all the coupons, talking to all the restaurants, sitting outside sort of offices, etc., to get all these offers and coupons. What we failed to do was speak to a single customer. And we learned it the hard way, that when we launched the product, it absolutely bombed. There were absolutely no takers for it. And that was for us, that lesson, even though it happened in our first year of entrepreneurship, will always stay with us, is to start talking to customers as early as you possibly can, even before starting the business, if possible. So at least that's from our mistakes. I mean, there are many, many of them, but there's this one lesson continues to stay top of mind for us, both while investing as well as sort of while building a business.
Sure. Okay, I'll just move on. This is an interesting one. If you could magically solve one world problem with a startup, right? I don't know magically, but if you could solve one world problem with a startup, which problem would it be and how would you go about it?
Probably weight loss.
How would you do it? Give us some advanced secrets. But yeah, go ahead.
We actually have some companies that are doing this, but not without using Ozempic, right? Like,
Right,
like do it in a manner that doesn't screw your body.
right,
Um, well, look, there are so many. I'm just joking, but like, I mean, that is one of the obvious problems. But like, I feel air quality in Delhi because that's where we live. There's so many. I mean, I don't. I think the list is very, very, very long.
mm,
That's what makes it exciting for us to do what we do because there's endless and absolutely endless number of problem statements out there.
right. Rohit, do you have one which is a pet cause?
I mean,
Weight loss, and of course,
well,
Delhi.
there's so many. I just
Uh,
it's hard to pick one, and that's one of the other things that we don't usually when investing we don't necessarily go in with a thesis that hey, here are the 5 problems we are finding companies for. We usually work the other way around because we've seen entrepreneurs have a lot more novelty in finding a diversity of problems that they're working on, and as a result, many times we do a far better job as reflectors of their opinions and trying to figure out whether this makes sense or not
right,
versus being generators of ideas for them.
sure. But there is a question. I think there was a conclave recently where they were discussing this quite a lot. Since we're talking about problems, world problems, is there a thought of purpose in a larger sense when you're thinking about versus profit? When you're thinking about entrepreneurs and their motivations, does that come up in the way when you go about your process? Is that a thing? I know there was a quite extensive discussion recently at one of these conclaves where they were talking about, early stage investing on how purpose is starting to become more important and it should be seen. Could you just shed some light on it? Is it a thing?
Look, I think there are two parts to it, and I'll answer that in 2 parts. In some ways, look, for us, there is obviously a purpose why we do what we do because both myself and Kunal are extremely strong proponents of entrepreneurship, have been for many, many years, and will continue to be for many years. And we just genuinely feel very strongly and passionately about entrepreneurship because we feel for a country to progress, entrepreneurs are absolutely essential to keep figuring out new problems and solving them in novel ways and make the country progress, generate employment, overall uplift the standard of living, etc. I mean, for so many reasons. And in some ways, while it's over a period of time turned out to be a commercially sound activity as well, but the origins of our investing lie in our passion for entrepreneurship.
Yeah.
That said, if we were to think about an early stage company, look, they obviously need to be solving a certain type of problem, but truth be told, for the first few years, a company's job is a lot more focused on making sure their product works and they're able to survive and scale than worry about bigger things like purpose. While there may be a purpose why they started the business, and that should stay intact, but look, they don't have the resources to have a purpose. They first need to survive and thrive to be able to fulfill some of those desires. And as a result, in early stage businesses, we've not seen them having larger purposes till the time they're able to, they get to a point where they can afford to invest behind those things.
Sure. No, I think that's a very fair and pragmatic way to think about this issue. Okay. Last question before we wrap this up, guys. There's a question around essential reading. That for investors. Someone asked that from today's session, and then one question we got was, is there a book or a show you think every entrepreneur should watch? So would you want to just answer? Just give some reading and watching ideas to people.
Sure. It's always fun. It's always, at least for me, it's fun reading as well as listening to either podcasts or interviews of either very seasoned public market investors, because their principles tend to be rooted in a lot of facts and they are very dispassionate in some ways, right? I think that's a good balance to what we need to do in our day-to-day lives. So, listening to like Acquired is a great podcast on Spotify. They do like these 3 hour, 4 hour podcasts on one particular company, do go very, very deep. So it really gives you a full download on their margins, how they thought about building their business, because it traces the journey from zero to whatever, $100 billion companies. It's really fascinating because that's at least what we intend to do as operators ourselves, as well as investors in the companies we are backing. Outside of that, at least, I try and limit my reading. No, I don't try and limit my reading only to business literature, because that can be very limiting, because that's all we would do then. I love history, so I read a lot about history and various, how civilizations have progressed. Like that's sort of my more anthropology related stuff. Like that is more interesting for me, because at some level, history teaches you a little bit more about human nature, and whether you're building a business or you're investing behind people, in the end, it sort of boils down to, having an assessment of human nature.
In fact, many great investors talk about reading history and psychology both, because like you said, it's about human nature, evolution of human society, behaviors, way people think about things and act, and that rounds you out as an investment thinker. So I think that actually makes a lot of sense. Rohit, do you have a couple you want to throw in there
Also,
quickly?
between the two of us, that's how we split. Kunal reads history. I read a lot more about psychology and human judgment in general. So
Right.
it's coincidental that you would bring that up. So for me, a lot of my reading is around, from an investing standpoint, it will sound cliche, but a lot of Charlie Munger's work. I mean, this is absolutely fascinating to read and reread it over and over again. Almost all I've read all of Nassim Taleb's books which are absolutely fascinating again, which many investors would have read, but I've always found them very, very insightful. One of the big blogs I follow is this blog called Farnham Street, which is again inspired by the same Warren Buffett, Charlie Munger school of thinking. So I think those are sort of in general topics of interest. For me, what I find interesting is reading a lot about both evolution as well as human judgment in some ways. So
Excellent.
that's
Thank you for sharing that. I imagine Daniel Kahneman is there somewhere as well in that list.
it is, but I mean, it features in every top 100 list. So I didn't want to mention that because
well, look, thank you very much. I think we're out of town. I just want to make a couple of concluding comments on investing in this fund and in this asset class. And this is really directed at our investors. The framework for investing in venture capital from a portfolio manager's perspective, people like us, advisors' perspective, rests on, I think, three important ideas. The first is that it represents private markets, which form a substantial part of the economy. Of course, that includes early stage, mid stage, late stage, and all, but private markets form a big part of the economy, and it's not accessible to everybody easily. But it is an important part of what's happening in an economy. Two, venture capital specifically represents high potential returns relative to higher potential returns, much higher relative to other asset classes, alongside diversification benefits and access to innovation, new technologies, business models, disruptive ideas, etc. Again, not possible in public markets. But the third point is it is high risk. And it's a high risk, at least from our point of view, high risk, high reward strategy in the way that the underlying instruments are quite illiquid. Many early stage companies fail. Even successful investments can take quite a long time to fructify. So it's crucial to have a well-diversified portfolio and to work with experienced venture capital managers when seeking this allocation in portfolios. That's why we have funds like the Titan Capital Winners Fund. We believe that this instrument does belong in some allocation in all portfolios of investors who have the requisite size, risk tolerance, time horizon, and understanding, right? And it's a long game. So you have to go through all the noise that will happen in the next 7, 8 years, 10 years that you have to deal with as you're invested in something like this. So it's important to have that understanding, but it does belong in most portfolios. So I hope that, some of the discussion today has shed some light on this specific opportunity that we're looking at. And of course, how Kunal and Rohit go about their business. We would like to really thank you, Rohit and Kunal, for a fascinating discussion and taking the time, and our guests for taking the time to attend this session. I hope that they found this useful and informative as well. I wish you all a very nice evening and a very nice weekend as well. Thank you very much.
Thank you, Shiv. Thanks, everyone.
Thank you, everyone. Thanks, Shiv, for having us.
Cheers.